Awesome. Thank you so much. Hello and welcome, everybody. Thank you so much for being here. As always, it's really an honor that you'd spend and invest a little bit of your precious time with us today. So thank you so much for being here. Let's see some familiar names and faces. Shout out to, let's see, Sarah Nurnberger. Was Christy Blake around? Who else? I don't know who Amy's iPhone is. And yeah, shout out to a couple of regulars, and I'm sure there's a few coming. I think Sherry Schmidt and Jeff Kendall should be incoming. So where to begin, you guys? A lot going on, a lot to talk about, a lot of changes to discuss with you all. Because I think we're in this time of, because I believe we're living in an era of misinformation, I'm going to try to do a little bit of fact versus fiction, sort of market edition. So, we're hearing some claims here and there. And I just want to kind of make sure we set the stage and make sure we get the facts out there, coming right from the North Star data, not conjectures or pontificating, but really getting the data out into your hands and helping all of us understand, so you can communicate that and convey it to your clients, buyers and sellers, exactly what's happening. And yes, there are some changes. I think some have been overstated and others may be understated. So let's talk about that. All right, let me get my PowerPoint going for you guys. And it should be going just about now. Give me a thumbs up if everything looks okay, guys.
You look good on our end, David.
Looks good. Okay. Thank you, Sean. Thank you, Sean. Saw you there. Okay. So let me make sure I got my chat open as well, just so I can just catch any questions that come in real quick. And yeah, so we're going to try this kind of new format, a little bit of a fact versus fiction format. I've got a couple sort of openers, some of which I hope are somewhat humorous, but I can't promise that. This is not one of the funny ones, but a real one. We cannot control the wind, but we can adjust our sails, right? And when the winds shift, you can still sail forward, but you do have to adjust your sails a little bit. Another thought during these times of change, when written in Chinese, the word crisis is actually composed of two characters, and one represents danger and the other represents opportunity. And the phrase is wei ji, and it literally is danger and opportunity. So, I don't want to make it seem so dark and, catastrophic. So I've kind of said in times of change, there are threats, but there are also opportunities. So all we can do is try to manage those risks while pursuing the best opportunities. Sort of my version, I have adopted it. Okay, on to some somewhat hopefully humorous slides to kick us off. They say economists have predicted 17 of the last 3 recessions. I don't know why that's funny, but it's funny. Recession, are we in one now? Okay, maybe not. Okay, how about now? No, maybe not. Okay, how about later this year? Maybe not. Next year? Maybe not, probably. I found this one funny, guys. Economists have predicted 17 of the last 3 recessions. Okay, another thought. So they say commercial real estate has changed. I know we're talking residential, but commercial has changed with the growth in e-commerce and virtual work and remote learning. But I found, ladies and gentlemen, I found a strip mall that will always have endless demand and will never fail. You want to see it? If I can buy this thing to the moon, it's really all about co-location, right? There's your 3-word mantra that you guys live and breathe. All right, so a little bit of self-awareness and humility here. I need someone well-versed in the art of torture. Do you know PowerPoint? Well, you gave my presentation 10 seconds time to check your phone. The reality is some of you out there might benefit from that little dog cone, the dog collar thing. It might keep you from checking your phone every few seconds. All right. What if I told you guys that stats can be fun? Because that's what I'm telling you. Let's remember that without data, you're just another person with an opinion or another realtor with a theory. So today I'm going to give you guys 10 takeaways. 10. I'm hoping you accept, maybe half of them, although I guarantee you they will all be factual. Although things change, right? We know that things change. Another guarantee, there are so few of those in this world, But I guarantee you, you will feel a little bit of information overload. It'll be a little bit like drinking from the fire hose. You will absolutely have slides after. So, feel free to take notes, but don't feel like you've got a screenshot or scribble down notes, for every slide, because you guys will have these. It's going to feel a little bit like speed dating, but with charts. So you're going to learn to heart the chart. You like that? I kind of like that. We're going to go with it. All right, enough with the openers, you guys. Now that we've got our analytical thoughts rolling, what's going on with payments? This is one that I think we hear a lot about. The media's asking about this. We hear this across the media spectrum, from CNN over to Fox News. We hear this being reported on across the media spectrum. And so, until recently, I really should change the title. Until recently, historically low rates and rising incomes have offset price gains. And what I mean by that is low rates and fairly resilient earnings have prevented the rise in prices from trickling through to monthly payments, right? So look at this. Even though prices last year were well above 06 levels, payments just weren't that high. I mean, even 2020 prices were way ahead of 06 levels, but payments were flat, actually technically even below by what, 15, 20 bucks. What we've really seen happen recently is the fact that prices are still high and even still rising, but at a lesser rate. We'll look at that. But when rates went from 3 to 5.7, that's what really affected the payments. Folks on our board have said for the longest time, this is a monthly payment business. I would bet 90% of the time, instead of searching by price, your clients search by payment. They say, we reverse engineer, right? That's where we start. We always reverse engineer from the payment to get to the price. And as you guys can see, $2,200 a month is, about $400 a month more than last year. That's $4,800. It's about $5,000 a year. That's not nothing. That's not nothing. I'd say that's noticeable, to your average Minnesotan, to your average Twin citizen. However, if that margin is going to make or break you, you might not be ready for home ownership, because it's not unheard of to have a $3,000, $4,000, $5,000 unexpected expense, whether it's, a sewer lateral, a furnace and AC replacement, something like that. I don't know, furnace and AC jobs run what, $8,000, 7, 8, I don't know. Depends on who you use. So it's not impossible to have that kind of surprise. But that kind of surprise on top of this, people are going to be feeling it. Here's what's interesting. That was the amount of monthly payment, but what about the percent of our pre-tax income? Because the amount is one thing, but what share of our income really is it at the end of the day? And you guys can see at the peak of the bubble, we were 24.8%, and now we're only 25%. I find that so interesting, and how fascinating. What a time to be alive when we only had to spend 13% of our income on housing. But here's the math, you guys. Your typical family's making is pulling in about $105K a year. 25% to housing is about $26,250, so $26,250, call it, which amounts to just about $2,190, $2,200 a month. So that's kind of how the math works. And it's really still only about a quarter of pre-tax income. HUD and other scholars and elsewhere in the literature, you'll see some say 28, some say 30%. If you're paying more than 30% of pre-tax income on housing, it's considered a little bit of a burden. You're considered sort of housing burdened. And we're not there yet. We're not there yet. So if price growth can level out a bit and income growth can continue, I won't be as concerned about this, right? But those are two ifs. Those are two ifs. All right, showing activity. Maybe I should have started with this instead of diving. We dove in deep, you guys. We dove in. We went in hard early on. So let's zoom out just a bit. Let's take a look at showing activity, guys. We've got 2019 showings in light gray. And then 2020, here you see the COVID dip in March, pretty unmistakable there. And then 2021, really hot at the beginning. Well, let me back up. 2020, look at how hot it was on the back half. And then 21, look at how hot it was on the front half of the year. 2022 here, it's still 2022, right? Yeah, we're still in the middle of 2022. I had to check. It started off pretty strong. You guys can see above 2019, basically on par with 2020. We didn't take that COVID dip, but we do have, Memorial Day and 4th of July dips, like you see here. But we are running, notably below levels from the last few years, right? And if you think rates don't have something to do with that, I believe you should reconsider your thesis. I think it has a lot to do with it. While we're going through this stuff, guys, quick poll, please do answer these. Would love to get your insight and input on these. And I'm allowed to remind you of them because this is not a CE course. Janetta will find that somewhat amusing, and maybe none of the rest of you will. So rising rates have had an blank impact on my client's decision. Pretty small or negligible, moderate, noticeable impact, or we're talking significant where they have just said, I feel pretty priced out and I'm waiting, or even worse, I'm renting for the foreseeable future. Okay, so 17% negligible, about 42 and 42 moderate or significant. Yeah, that seems about right, guys. Moderate. So yeah, 44 moderate, about 40% significant. That sounds about right to me. Let me do a quick screenshot of that, like that. Oops, that didn't work as I would have liked. Okay, good stuff. Thank you, guys. Okay, moderate, more on the moderate side now. It looks like 46% moderate, 38 significant. Okay, thanks, guys. We'll let, I think, 3 of you keep rolling in if you'd like. So just looking at showings, just looking at the showings numbers, why do we care about this? This is the thing before the thing before the thing. Before you sign a contract, you have to kind of walk, well, you likely have to walk through the house, right? You have to see it. And then before you close, you have to sign a contract, right? So it has to be newly listed, then active, then shown, then under contract, and then closed off market. So this is what we like to refer to as the life cycle of a listing. And so the sooner, or I guess the earlier on in that cycle we can get, the more of a leading indicator we can kind of look at that we can deliver. Okay, enough of that. Let's jump into our fact versus fiction. Hang on, priced out or tired of the competition we saw earlier. Yeah, Sean, I think you're right on there. Yeah. And then because there's a little bit less competition, it's not that there's no, there are still multiple offers, plenty of them, but maybe that's motivating, that could be a motivator for some people to say, even though we might pay an extra couple $100 a month, we may not pay 20 grand over asking. So, life is a balancing act. And if you're asking me, I'm going to run the spreadsheets to look at it. I'm not going to do the 30-year because no one stays for 30 years, but I might look at an 8-year, or a 10-year sort of payback, or, how it looks different. All right, fact versus fiction, guys. Fiction. The market is crashing. How old is Macaulay Culkin right now? I don't know. All right, fact. It's not crashing, you guys. The market is rebalancing and normalizing, coming down from historic pandemic highs. So we've come down. We haven't crashed. Right now is actually kind of normal. In fact, we're still hotter than normal. What we had was not normal. We're getting back to what's normal. It looks like a decline because we're going from Mach 3 to Mach 1. Right? So it really feels like a slowdown, but it really is just getting back to normal from really being white hot, right? Red hot. Now we're, warm, still warm, pretty warm to the touch, but let's see what happens. Minneapolis, St. Paul housing market is definitely in a bubble. This market's driven by high demand and low supply, right? And cheap money, but not easy money. We're still well below our long range trend. Shifting rates, the changing rate environment, and deteriorating affordability. And we should name those things, guys. We can't be roses and sunshine all the time. The reality is that the affordability picture is just about as low as it's been since at least 2003. So we're working with kind of a 20-year low in terms of affordability. Doesn't mean nobody can afford a home. In fact, it means, what is it? The median income is what, about 98% of the necessary income needed to qualify for the median priced home. Guys, parts of California are 30, where the median income is 30%, about a third of the needed income required to qualify for a loan. So we still have tight inventory as well. That's been shoving prices ever higher. And then don't forget, guys, I think this is really important, and this is a missed piece. some demand, sales activity that would have taken place in 2022 and 2023 has been displaced or shifted earlier into 2020 and 21. Why? Rates were unbelievably attractive. Folks needed more room for remote work and remote learning. And so folks who would have bought maybe in 22 moved that into 2020 or 21. So I think we're still a little shy on our demand because demand that would have happened now has been shifted a little bit earlier. Did I miss one? Yes, we're nowhere near as bad as most other places. If you want to talk about bubbles, you guys, let's talk about bubbles. All right, I don't always love the Case-Shiller data. Most of you know that, but I will use it right now. This is through the most recent. So look, this is USA. What's USA? Oh, USA, sorry, USA. This is USA here in blue, and then Minneapolis here in pink. And look at, guys, look at the price index for the nation versus where we are. You think that tells the whole story? How about some of our sister cities, our peer cities, peer regions? Here we are sitting in Minneapolis, below the nation, right? We did not rise as much and we will not fall as hard. That's a good thing. Man, oh man, what is going on with Florida? What's wrong with Florida? Look at Tampa and Miami, not even showing any signs of slowdown. Phoenix, that was red hot, prices increasing 35% year over year. I mean, that's like going from 300 grand to 400 grand in a year. It's pretty insane. Slowing down, most other places kind of turning a corner a little bit, except for Florida. It's always Florida, isn't it? Is it Jimmy Fallon who has was it Florida or Wisconsin, or is that Jimmy Kimmel? I can't remember, but they always do these news headlines. And where did this take place? Florida or Wisconsin? And it's usually one of those two places. People leaving California, what's Sean saying? Leaving in New York and moving to Florida. Very true. They're also moving to Austin and Phoenix, and Charlotte is pretty hot. Yeah. So you guys can see, right, a lot of these other regions, Atlanta, I mentioned Charlotte and Vegas, and some of these guys are turning a corner. Again, getting back to average growth rates between 5 and 10%. 30%, guys, is not normal. Not normal. Not sustainable, not healthy. Prices way too many good people out of the market. It's just unsustainable. So yeah, we're going to get back to 6 to 8, 5 to 7, 6 to 8%. We're going to get back to that, and that's where we belong. That's been our historic sort of average. Okay, guys, I got to keep trucking here. I've been geeking out on way too many of these, way too much. Okay, the Great Mean Reversion, all the way back to 1960. I love the historical data. Sometimes Jackson and I differ on that. Sometimes he likes to just zoom in on the last 5 or 6 years. And God, I like seeing the last several decades because it to me, I think it grounds where we are and kind of where we've been. And we can kind of see that long range trend, right? Look, hyperinflation in the 1980s, guys, that's the 4-decade period. That's when you hear that inflation's running at a 4-decade high. We're comparing to 1981. So you can see inflation, rose a lot. And so prices kind of leveled out a bit. Deb, I'm right there with you. But wow, look at our run up into the bubble, into the 06 bubble. It is so visible. We got way ahead of our trend. So as I say, you guys have probably heard me say that was our party and this was our hangover, right? So, there we were. So we kind of blew through this zone, this sort of average zone. By the way, we'd be right in the middle of this range if prices grew at a steady 5.5% year in and year out, but that's not how price movement goes. So you can kind of see the effect of the housing bubble and then the crash. And look, guys, check this out. We're just kissing the bottom end of the range. We're just starting to flirt with that bottom end of the range. We're not above the range, right? So this is concerning. This should have caused concern. This should have raised red flags. Please don't throw tomatoes at me because I wasn't here in this industry then. I was finishing my master's program. So not my fault. So, guys, we're way ahead of trend here, and we're actually not. We're really not too far over our skis right now. But we are getting back into that range. Whether we level out, whether we kind of do something like this remains to be seen. So we'll have to kind of wait on that. Guys, bubbles need easy money. I mentioned we have cheap money, but we do not have easy money. And that's a really, really important distinction. So lending standards based on the MCAI, the Mortgage Credit Availability Index, still very much under control. You can kind of see how loosey-goosey we were with mortgage credit back in the day, back in 05, 06, and just how different of a place we're in today. All right, buyers and sellers, let's take a look. New listings annual, you guys. So this is for, well, excuse me, I should say year to date. So annual so far. So this is year to date. So you guys can see all this supply coming onto the market in 06, a lot of supply, oversupply. And then kind of heading into the crash, looks like new listing activity, not quite cut in half, but chopped. We had recovery, and then we're basically back down to 10-year ago levels, you guys. 37.1, 37.9. I mean, that's pretty darn close. So that's not exactly what I'd call encouraging from the supply standpoint. But as we see demand come down, maybe that's an okay thing for supply to kind of be doing this. Maybe that's okay. But we saw a little bit of an increase in 21 when we had all that moving. So people had to list to move, at least 90 some percent of them did, minus the people moving out of state or moving into senior living or another form of institutionalized care. Let's look at pending sales though, guys. This is where we can really notice the changes and the sudden sort of jerks in the market that we've seen, not like jerky people, but some of the knee jerk and the sudden dramatic changes that we've seen. So take a look at pendings. Signed contracts soaring 11.5% in the first half of 21 compared to that same first half of 20. So yeah, no surprise, we had to cough up, that 11 or 12%. And here we are sitting at about 29.5, 29.6. You know what? That's just really not all that different from 2018, 19, or 2020 levels, right? Now remember, the first half of 2020, well, January, February, and the first half of March were in the BCE, the before COVID era. I understand BC has other connotations in a biblical sense and whatnot. But I call it before COVID, the before AC after COVID, BC before COVID. But when you look at pendings on the year so far, you guys, it's not that concerning. We're kind of getting back to normal. Yeah, July, we're in a couple slides, I'll show you guys, July pendings were down 18%, right? 18 and change. Looks pretty dramatic, and I guess it is, but I think that's because there was this sudden knee-jerk reaction to rates, and now there's evidence rates are actually back down around 5. When they were flirting with 6, just a month or two ago. So let's see what happens in the back half of the year. Millennial, I think there's still a ton of pent-up demand from folks that just didn't feel like they could make it happen, who couldn't, reach or stretch or get qualified or felt priced out or whatever, over the last couple of years. So let's see what happens in the back half. I think it'll be interesting. New listings, July, broken down by price point. Blue under 350. Red 350 up to 600, and I realize that's a wonky range, you guys. 365 is sure different than 575. There's no doubt about it. But call this the sort of, I don't know, well, 350 didn't used to be entry level, right? 180 used to be entry level. 225, 250 used to be entry level. Now 350 kind of feels a little bit entry level-ish. And then call this, I don't know if we call this luxury, but call this maybe a second move up or a third move up. Or early luxury, young luxury. I hope that's not a rapper name, young luxury. Okay, guys, so new listings. So look at under 350. This is where we see the change. This is where we see sellers pulling back. Why? Do they really want their payments to rise if they listed their home and moved? Right, guys, these are folks who are just much more budget conscious. And there's a reason they don't own a $700,000 home, and there's a reason they own a $340,000 home. And that's probably because, that's what their budget allowed. That's the monthly payment that they were comfortable with. So that's where you see the biggest pullback. Now take a look at 350 up to 600. We actually see an increase in listing activity so far for the year. And then look at 600K plus, still a pretty nice gain over on the demand side. Again, you guys, this is where we see the demand really pulling back down 23.5% from about 40,000 to just about 30,000. So there's our roughly quarter decline. 40 minus a quarter of 40 is 40 minus 10 equals 30. So take a look at 350 up to 600, still a little bit of a gain here, but definitely flattening out. And then 600K and up, also a gain here, but also flattening out, right? We can definitely see a flattening in terms of pendings. So guys, there's a pattern here where we see the changes in rates are impacting those who are the most rate sensitive, right? And those are these folks who are the most rate sensitive. Well, while investor activity is on the rise, we do not believe it has reached a catastrophic levels, but it's something that we're really kind of thinking about and looking into. Do you guys think BlackRock and Goldman Sachs are rate sensitive? I think BlackRock has like $20 trillion, or no, maybe not that much. I think they have several $1 trillion under management. They're paying cash. They don't care if rates are 1% or 50%. They don't care. They do not care. They have so much cash on hand and they're looking to deploy it. And they're gobbling up properties. I'm going to do this very deliberately. Notice which hands I choose. On the right hand, we live in a capitalist free market, right? And he or she who hath the money, hath the luxury of purchasing the thing. On the left hand, right? Homeownership maybe should be preserved for humans, for people, so people can gain some equity, so people can maybe rely less on other forms of assistance. People should own homes. People should be putting down roots instead of maybe Wall Street firms. And when they flip these, or I should say, when they convert them to rentals, a lot of single family conversions to rentals. Do you guys think those are going to be listed again soon? I probably don't think so. It's a cash cow generating revenue, and it's an appreciating asset. That sounds pretty enticing to me. And frankly, if I was one of their shareholders, I don't think I am. Maybe they're in some mutual fund I am. But if I was one of their shareholders, maybe I'd want that too. But it's a little bit more complex than that. So I encourage you guys to think through that. All right, I got to stop geeking out, guys. We're halfway through, and I am not halfway through my slides. Okay. So let's look at the ratio. We just looked at seller activity and buyer activity. Let's take a peek at this ratio. So this is the ratio of pending sales to new listings. What this is telling us is for every 100 new listings, we had about 70.5 signed purchase agreements, accepted offers. Now, check out July of 2020. For every 100 new listings, we had 86.5 pendings. Buyers are chomping at the heels of these sellers. They cannot get ahead of them. Sellers cannot get ahead of these buyers. These buyers were gobbling up everything right away, and everything that was listed just was gone so quickly. So here we are, 70%. All right, yeah, that is below where we've been for the last several years. But I mean, 70% still relatively high, right? And it's kind of between the 65 to 80 that we've been in for several years. So I mean, does this reflect a shift? Yeah, I definitely think it does. Does it signal that the sky is falling? No, I don't believe it does at all. And then on a year-to-date sense, again, because June and July were pretty wonky, you guys, just given what happened with interest rates. So I think it is useful to look at maybe second quarter data or year-to-date data. So for year-to-date, for the year so far, 77. So we're still ahead of the sort of 2016 to 19 period. But yes, we are below 2020 and 2021 levels as anticipated. All right, let's shift gears into some long-term trends. Don't be mean, be above average. Statistics everywhere, Woody. All right, fiction. Sellers are flooding the market to take advantage of strong pricing and will soon cause an oversupply issue. Yeah. So we just looked at this, you guys. I won't read everything here. In fact, they say not to read the words on every one of your slides, but new listing activity is down. Many folks are choosing to stay put and remodel due to these higher payments. A lot of our boomers are choosing to age in place. But as we saw, guys, we talked about this, especially folks on that affordable end of the market. Where are they going to go if they sell? Where are they going to go? They'd probably get a smaller house. They'd pay more for a smaller house, maybe in a less desirable location, and their payments would be substantially higher. So can we blame them? No, I suppose we can't. We talked about investments. And then here's an interesting idea. Some will choose to rent out their first home to offset that extra monthly cost on their second home. Interesting thought. Does that make them any better than the Wall Streeters? I don't know. Maybe, maybe not. All right, so new listings just for July, guys, down 16% to just under 7,000. So that was the reading that we had, and that is the lowest level since 2011 and 2012. That's a fact. Home buyers are nowhere to be found. They've run for the hills. You know, the reality is, you guys, and again, I think it's important to name this stuff and say it out loud. Some folks have been priced out of the market. In fact, a lot that happened 2 years ago for some. But yeah, with the change in rates and with the change in payments that we saw earlier, you know, affordability really is a concern. It's mostly the shift has mostly been, I'd even say, what, 3 or 4, you know, 4 or 5 months. It's really been this year since we started getting those inflation readings that forced the Fed to start hiking rates fairly aggressively. Yeah, 0.75 point increases. So guys, sellers, you know, most of you see this. Sellers are still getting multiple offers. Maybe they're not getting 40 offers. Maybe they're getting 3 or 4 offers. Maybe they're not getting 100 showings. Maybe they're getting several dozen showings. So, you know, a change, yes. A crash, no. We talked about that displaced demand stuff. And then, you know, inventory is still historically low, and that's frustrating and sidelining buyers. Even if rates were still 3.5% or 4%, you know, we still saw that pressure on buyers. And then don't forget, we've mentioned this, but we're still comparing to that uniquely strong market last year. So it's not truly apples to apples. Sales now reflect contracts written in June or July when rates were what, 5.7, 5.8. So now rates are actually closer to 5%. And I actually saw them dip to 4.99, but then I thought I looked today and I thought they were more like 5.13. So, you know, let's see what happens over the next few months. This could help stabilize or bolster demand, depending. So there you have it, my friends. June pendings down 18%. June pendings down 18% to about 5,600. That is the lowest level since 2014. Lowest level since 2014, you know, and you know, down from these COVID highs, right? Down from these COVID highs. One more kind of interesting insight or observation, you know, June pendings were starting to soften before COVID. So there's some evidence that the, you know, buyers were running into this inventory wall and it was starting to pressure sales. Now this is just June, and as goes June, not necessarily goes the year. Let me rephrase that. The year doesn't always necessarily reflect, you know, just how June went, because it turns out there's winter, spring, and fall months in a year as well, at least at last check. So yeah, guys, pendings down a notable amount, but it's from really high levels, absurdly, you know, sort of uniquely high levels from the what I call the COVID reshuffle, when everyone wanted single family and some more square footage. So that is what the chart looks like. What was going on here? You guys remember that tax credit in 2009, 2010? Little bit of a tax credit bump there. That's why that looks kind of funny. You know, guys, let me just geek out on that. Let's nerd out on that for 10 more seconds. Can you imagine if we didn't have that incentive, that outside impact on the market, that external force, the same way the pandemic was an external force, you know, over the last couple of years? Imagine without that incentive, what would sales have done? Well, they probably would have stepped down from 4,000 to 36 or 3,500 and then stepped down to 3,100. But instead, it looks like a 40% decline. Well, it wouldn't have been such a sharp decline without that external thing, right? Without that factor, that force. And so we do have a little bit of the same now. Now, if these 2 years were normal years, you guys can kind of envision something that looked a little bit more like that. And, you know, housing does happen in cycles. Here's a cycle, here's a cycle. And I think it does follow rates a little bit, but also unemployment and the economy, the broader economy too. So, you know, we've had an inventory shortage for years, many years. I think Jackson and I found a couple press cycles ago, we've been in a seller's market for over 10 years. I think we just crossed that 10-year mark. So pretty astonishing kind of any way you slice and dice it, guys. All right, let's keep trucking. I keep saying that and then I keep geeking out on stuff. Sorry. So closed sales, you know, pretty similar story. Of course, they're going to follow pendings. Okay, let's look at the next piece of fiction. Homes are taking forever to sell. Well, homes are taking 4 days longer to sell, which is a 57% increase. So that is a notable increase. Again, I think we should name that. but we're still at a historically fast pace. Check it out, you guys. CDOM, just July, cumulative days on market. The midpoint, median, half the homes taking longer to sell, the other half of the homes selling in less time, fewer days. Look, 17 to 7 up to 11. So sure, 4 days, 57%. That looks pretty extreme, right? I'm going to say that looks and feels pretty extreme. But this is why we have to put this stuff in context, you guys. We have to contextualize it, and sort of put it in, in step with the historical data. So we went from 17 down to 7 and up to 11. Homes are still selling significantly faster than they were, pre-COVID. 100 days, wow, 100 days, we're selling 90% faster compared to 100 days. Guys, remember, this is a median. Some homes are taking 100 days to sell. I think there's even some multi-million properties that are taking 200-300, maybe even 400 or 500. They probably will delist and relist or expire or cancel or something. And then we still have homes going off market in 4 hours. We still have accepted offers in 4 hours. So some 100 days, some 4 hours, that midpoint, just about 11 days. It's still breakneck speed, guys. It's still really quick, but not as quick. All right. Fiction, home prices are in free fall. Every $400,000 home will soon be worth $250K, maybe 300. And I can soon start to tell my buyers they can lowball sellers again. In fact, home prices are continuing their ascent, although at a slower rate of change. So price growth has decelerated, not decreased. Well, the rate has decreased, but prices haven't decreased. The growth rate has decelerated from 16% to more like 7%. That's a good thing. That's sustainable. 7% is much more in line with our historical trend than 16. 16 is the outlier, you guys. 7 is not the outlier. 16 is the outlier. So price growth has come down 50%, and that's a great thing. That's a great thing. We really do believe that home prices are unlikely to soften in the short to midterm, given this persistent imbalance between supply and demand. But again, let's see what happens with the economy. We're watching all that stuff. I am not a betting man. I'm truly not. I think I've been to Vegas twice, and you bring $500 and when it's gone, it's gone. But I do have a bet. I have a $100 bet with, actually, I'm embarrassed to admit, I have a $100 bet with 2 different friends that prices will not fall year over year through the rest of this year. They took the bet. They took that side of the bet. So I took it, and I'm thinking I'm going to win. I also have a bet that we will not see new lows on the S&P this year. I've got that bet as well. We will not see fresh new lows. I think we've seen the lows. This is not financial advice. This is not anything. I'm not a financial advisor, but I do have those 2 bets going, and I thought I should tell you. All right. One more poll for you guys. This year's real estate market is, are you thinking busier than last year, a little bit slower, mostly the same, or maybe you didn't do any deals last year? You were busy doing other things, just trying to survive the crazy world that we live in. July median sales price, guys, up 7% compared to 12%. And that's just July. We did have some 14 and 15% months. So here we are at 375 compared to the peak at 233. Prices have been marching ever higher. Here's an interesting thought, and I think this is underappreciated. Homeowners with fixed housing costs who aren't buying cars or flying are experiencing much less inflation. Why? The CPI, the headline CPI, forget the core, but the headline CPI, the Consumer Price Index, does include shelter. So the rising cost of shelter, rising home prices, and rising rents has been a major input into the CPI basket of goods, and that's been pushing that inflation reading higher. But guess what? Homeowners with fixed housing costs aren't experiencing that, right? Sure, you might pay, another couple $100 in taxes every year. Okay, fine. Maybe another couple hundred in insurance every year, but what a small price to pay compared to folks whose payments might have gone up, much more significantly than that. So if you're not buying cars, you're not flying places, and if you have fixed housing costs, you're still going to experience, at the pump, I'm seeing 360 now. I think I saw 360 at the holiday off Normandale the other day. So, I know that's getting better. Oil has been below $100 a barrel for several trading sessions. So we start to see stuff kind of coming down on the back end on the commodity side. Hasn't all trickled into, the retail environment. Grocery stores are at the fuel pump, at least not as much as I hope it will. But, just know that your mileage may vary and that your experience will vary. Okay, on that topic of inflation, let's take a look at this one, guys. So these next two are interesting. You'll notice something. Red doesn't change, does it? Red doesn't change. What changes? The dollars that we're using. Okay, that's enough of that. I'm sorry, that was a lot. So the dollars that we're using, guys. So nominal home prices in red. There's our 230 peak and there's our 375 current level. Nominal home prices, simply the prices that we paid at the time. What if we frame those prices in constant $2,003? So notice they're at the same point because they're both using $2,003, no inflation. Over time, look at the divergence. These are inflated dollars. These are real inflation adjusted dollars. So you can see this acceleration in price growth. Part of that is, I think inflation does play into that. But look, when we strip out inflation, you actually can see us leveling off just a little bit. And then the other way to look at that, of course, is instead of using $03, let's use 2022 dollars. So now both real implied home prices and nominal home prices are both the same because they're both in 2022 dollars. If we push that backwards, though, look at what we would have paid if we used today's dollars. So this is interesting. If in 2003 you bought a house using today's dollars, you would have paid what? What does that look like? 310, maybe 315. Okay, so that went to 350 and now it's at 375. So when you actually talk about real dollars, I don't know, like 350 versus 375, maybe we're not that far ahead of peak when you really adjust for inflation. Maybe we're not that far ahead of peak. So I thought that was pretty interesting. Monthly mortgage payments through the roof. So monthly principal, interest, taxes, and insurance payments have risen. There's no question about that. But as we kind of saw, they're not as bad as they could be, and they're not as bad as they are in other regions. Guys, forgive me here. I think I had a slight goof. I showed this one. I pulled this one earlier. So we're going to skip these. You guys already saw those. Let's skip those. Apologize about that. So fiction, another piece of fiction here. Home sellers are getting much weaker offers. So the fact is, sellers are still getting offers over 101% of their list price, which, while it's down from last July, it's still historically high, ridiculously high. Let's take a look. Percentage of original list price received at the time of sale. So we did have to cough up 2% of that, right? So we went from 103.5 to 101.5, right? So there's the roughly 2% that we lost. So here we are at 101.5. Guys, sellers are still getting strong offers. Buyers are not going to have a lot of success lowballing. However, buyers should take some comfort in the fact, in the notion that instead of going 5-10% over, they may be able to go 1% or 2% over. And this fall, it may be more like 99 or 100%, right? And guys, 103% is not normal. So we see this minus 2%. Oh my God, sellers are getting 2% weaker offers. Okay, I mean, technically true, but they're still getting this, 1015 is a historically strong level. Historically strong level. Okay, let's keep going. So another piece of fiction, inventory levels are surging and we will soon be in oversupplied territory. Inventory has risen slightly, but it still remains near, multi-year lows, actually even multi-decade lows. So this is the result of demand falling a little bit faster than supply, as we saw. But let's also keep in mind, we're comparing against a uniquely low inventory period last year during the boom. Let's take a look, July inventory. So this is July of every year going back to 2003. You can see the supply build up into the bubble. And then after the crash, we had to clearance that product out of the market. We had excess product had to clearance it out of the market, fire sale. Some of it was distressed, shorts, lender mediated, you name it. So we had to clearance that out. Now take a look at what's been happening more recently. So yeah, okay, a nearly 7% increase in inventory. Let's not make it seem like buyers suddenly have 100 times more options. You have to remember, guys, look at what happened in 21. This was sort of a uniquely, well, I mean, I guess 2020 as well, right? These are pretty strong declines, and we've had an up month or two, another quick, brief, tiny up month. But really, absent the pandemic, can you guys kind of see these levels stepping down from 13,000 to 11.5 to 10 and then down to 9 or something like that? So, the only reason I say that is just because I just want you to keep in mind that these were not normal years. So if we were in more normal years, I believe we'd still be showing an inventory decline had we not experienced what we experienced over the last couple of years. All right, something else. Jackson and I have been working on this, over the last few months. We've used it a little bit here and there, but we really haven't brought it into prime time yet. So in dark blue, this shows us the current inventory level by price range, right? In each of these price ranges, 120K and under, all the way up to our friends in luxury in $1 million plus. And then we've got the shortage. So what are we missing to bring the market to a balanced market, to 5.5 months of supply? So look at how fascinating. So inventory. So technically, we might have a little bit of excess supply between 500,000 and 750,000, right? And that's pretty interesting. I know there's a lot of builders in that zone. I know there's there's also a lot of move up buyers. Don't forget though, luxury's been on fire. So some folks might have sold a 7 or a 750 and thought more about a 9 or even $1 million. Guys, people weren't spending money. We weren't going out to restaurants and out to the bar and traveling and all that stuff. So luxury absolutely took off. And remember, high net worth individuals have a lot of their assets in the stock market. What's the stock market done over the COVID times? To the moon. All right, fiction. We are now in a buyer's market because of the changes that we've seen. Not even close. The fact is, we're not even close. We're still in a solid seller's market where sellers still have pricing power and the upper hand during negotiations, but slightly less so than last July. Sorry, guys. And remember, that's overall, not in every area or price point. So let's take a gander. Ooh, 1.8 months of supply, right? 0.3 of a month more than last July. So, okay, month supply is up 21%, but it's still below 2019 and 2020 levels. And that's really only up compared to, I don't want to say an artificially suppressed, but, compared to a low baseline. Maybe that's how we should put it, compared to a pretty low baseline. Just because of time constraints, guys, I won't do this, but just know we're in and have been in a seller's market. We used to be in a buyer's market, haven't been for a while. We're aiming for a balanced market. It seems elusive. All right, buyers, we're going to speed through some of this, guys. I apologize again. I paused and geeked out on some of these a little bit more than I thought I would. So we are going to do some speed dating with charts. Median age of home buyers, first-time buyers, dark blue, 33 years old. They've had to, look, when home prices went on sale in 08, 09, 30-year-olds could be first-time buyers. As prices have risen, they got to wait a little bit longer for that down payment. A couple merit increases in their compensation package at work. And then you see repeat buyers as well, 55, 56. So those guys have just been getting older. They've been aging, they have been aging in place until they're a second-time buyer. And some of these are going to be, well, some will be empty nesters, some will be move down buyers, some are move up buyers, some are move down buyers. So it really does vary. First time buyers, 50% when home prices went on sale in 09, right? And now you guys can see it has been declining, and all of a sudden, right, in 2021, we did see that 34%. So that was the highest level in several years. Median down payments for first time buyers in dark blue, they're doing about 7%. So some are doing 3.5, some are doing 10, a lot are doing 20%, but that median is still at about 7, which is roughly somewhere between 5 and 10. Let's see, repeat buyers, those guys are able to get much closer to 20%, so 17%. Median seller tenure. How many years have you spent in the home before moving? Guys, this industry has said for, I almost said decades. I think, well, no, I shouldn't say centuries. For decades, people move every 5 to 7 years, 6, right in the middle of that 5 to 7 range. Until after the Great Recession and the housing crisis, we stayed put, right? People stayed put for much longer. We're married to our mortgage rate, uncertainty, you name it. Where am I going to go? And then suddenly we saw people move with all the sales activity. We actually saw that 10-year fall to 8. It'll be really interesting to see in early 2023 when NAR runs these numbers for 2022. I'll be really eager to see if we stay at 8, go to 9, or maybe touch 7. That'll be really interesting to see. So I'm waiting on that. Not a ton to see here. Just know, guys, first-time buyers versus repeat buyers, this is the difference. Sources of down payment, proceeds from the sale of my primary residence. You've got the repeat buyers in light blue. They've got that, right? They've got the proceeds. They've got all that equity that they extracted from that first house to roll into the next one. And first-time buyers just don't have that. And that's really, and that's hurting. That's really hurting. All right, Twin Cities inspections waived. 55% of inspections waived, and that's for April. And then now our friends at Home Free TC, I think they do title work. So this is not MLS data. I do not endorse this data, but it does pass smell test. And I've been assured, I do trust the people who do it. I do, but just take this with a grain of salt. But they're showing 37% in the paperwork that they see at closing. Price reductions, there are price reductions everywhere. So let's name the fact price reductions are up from last July. Important to acknowledge that, but price reductions still remain near historic lows. So July had the second lowest share of price reductions in 20 years. Let's take a look. Guys, there was one point where 45 to 50% of our deals required a reduction. It's just the environment we were in. It's what it took to get the property sold. As the market's gotten hotter, not as much of a need for price reductions. We've gone from half to more like a fifth, right? 20%. Turns out only about 1 in 10 listing agents convinced sellers that they needed a price reduction in July of last year, or sorry, in July of last year. Versus about 15.5% last month in July of this year. So it's up notably, right, as a 50% increase in the share. But it is the second lowest July on record in 20 years. I think we have to kind of balance that out. I think we have to name both. And then just another way of showing this, instead of just July, we're looking at every month. Going back to 2019. So you guys can kind of see the seasonality in that, which I always just find interesting. Believe it or not, according to KCM, a majority of consumers still say it's a good time to sell a home. Just about 3 out of 4. Homeowner equity growth. I think I did find a more recent one. I was digging around for one. So third quarter, guys, you're talking about 33K in equity growth. More recently, first quarter of this year, you're talking about another 30. Now that's like a 10% price gain on a $300,000 house, but our median is 350. So what is that, an 8 or 9% gain on 350? So it looks like a big number, and it is, but it's just 10% price. It's just 10% value growth on a $300,000 home. That's not that unusual in a year, especially lately. We're in 2008 all over again. Is that from Liar Liar? Does anybody know? I think that's from the movie Liar Liar. Anyway, I used to be a big Jim Carrey fan. Fact. No, we're not in 2008 all over again. Guys, we have so much more of an equity cushion. Our borrowers are infinitely more qualified. And while we're doing this, guys, just a quick reminder, my team, my reliable friends, Janetta and Jackson, are doing such a great job of keeping these polls rolling. And I'm doing just a mediocre job of calling them out. So I want to draw your attention to the market expectations poll. What do you expect from the market over the next half a year to a year? Looks like, yeah, about 2/3 hold steady. Yeah, less than 10% say heat up, and then about a quarter of you soften. Sounds about right to me. That sounds about right. Okay, let's keep trucking. So more qualified borrowers, guys, houses are not ATMs. Unemployed people aren't buying houses. People coming off of forbearance. We don't see any mass layoffs, at least not yet. We don't see the kind of predatory lending that we used to see. And if you take a look at this, you guys, look at foreclosure activity. 150,000 versus 3 million. I mean, it's not even comparable. And then you see the years in red with over 1 million. I do see we're just coming up on time, you guys. If you'd be willing to just give me an extra 3 or 4 minutes, I'd be so grateful. But if you do have to disappear, thank you so much for joining us. And I really hope you'll join us next time. But just a couple more here to round us out. Take a look at this one, guys. This one's a little geeky, I admit, but look at mortgage originations by credit score back in 2003 versus through first quarter of this year. These are highly qualified individuals with 760 plus credit scores. These are more high-risk borrowers with sub 620 credit scores. Look at how many higher risk borrowers we gave mortgages to back in the day. Do you guys see those folks re-entering the market? I don't. Where has all the demand come from? It's come from unbelievably, incredibly well-qualified borrowers. And now they're sitting on a whole truckload of housing equity. So I'm a lot less worried this time around. I'm a lot less worried. Mortgage originations with sub 620 FICO scores, 06, $375 billion, 2020, $75 billion. There's a big difference there, you guys. Cash out refis percentage of all mortgages, 06, 90% treated them as ATMs. Now only about 38%. All right, here's a little piece of fiction. If we enter recession, home prices must decline. False. And oops, I think I meant 4 out of 6 here. 4 out of the last 6 recessions saw rising home prices, right? The big exception was 2008, which was a housing caused recession. Other than that, it was 91, which is not even 2%. Otherwise, you know, the last several recessions, prices actually gained. So we've got a better than 50-50 shot of prices rising from the time we enter recession to the time we come out of recession. So recession does not equal housing crisis. Your next question you're probably asking, do home prices always fall when rates rise? It's actually not true. Home prices have risen during several rate hike cycles. Check it out. When rates went from 12 to 14, 9 to 11, 7 to 9, and 7 to 8.5, look at what home prices did during those periods, right? Home prices rose during all of those periods. This time could be different, you guys. This time could be different. But I think it's worth using this historical context to say, you know, it's not a foregone conclusion. Okay, rounding out here, guys, 30-year fixed. So here we are, 5.13. And if you actually dive in, I'm not sure. Oh, look at me. Would you look at this, my friends? If you actually dive in, I'm not lying to you guys. I wouldn't do that. Check it out. We touched 4.99 for Thursday, August 4th. 4.99, and then, you know, we kind of ticked up a little bit and now back down. You know, if we can break that low, I think that would be great. I think folks would really like to see 4.75. I'm not sure we'll see the 3s again for some time. Probably, surely not the 2s for some time, maybe ever. But, you know, I think 4 3/4 would really be a nice thing just to touch, just to remind ourselves what that feels like, and to give some buyers a little bit of an extra entry. Guys, rates are rising. Does this look like the norm to you? That's the exception, not the norm. If you actually, again, if we, let's do a thought experiment here. Let's pretend there was no pandemic. Boy, don't we wish that were true. Let's pretend COVID were not a thing. Look at the rate trend. We're exactly where we should have been. Were rates to continue on the trajectory they were at? Remember, rates did touch, I think it was 4.94, just about 5% in 2018, late 18, early 19. It's funny, we didn't hear many people complaining about that. You know, and now here we are, we're back at 5%. We're all the way back down to late 2018 levels. Maybe that's how we should talk about it. So, you know, people talk about rates going from 3% to 6%. Well, sure, but that's because we dropped them during, you know, a pandemic. So just, again, take it with a grain of salt. All right, last one, guys, we'll wrap up here. a quick forecast from NAR. So they're thinking unit sales this year down 13%. We've seen a down 17%, but that's only for 1 month. We have seen the declines have been much more moderate. And again, let's see what happens moving forward. They're thinking home prices up 11%. I'm thinking we'll probably do more like 7 or 8 is my bet. But remember, they're national, and that includes, as we saw, that includes Florida, like it or not, but also other really hot markets: Boise, Austin, Charlotte, Denver. What am I missing? Others, Atlanta, others. And this is what several of them are thinking, average of 7, including NAR here. I think this is probably better, 8.5%. I still don't know why our friends at the Mortgage Bankers Association are such perma bears. They're permanently bearish. Maybe that's because they know something we don't. Anyway, guys, here we are at 3:05. I want to say thank you. Again, so much. And let me do a quick check of chat. Priced out or tired, 44 years old. Yes. Refi is to get into better. Yeah. Sean. So Sean, I really like what you mentioned there. I can't remember who I was listening to, but they were saying, listen, interest rates change, but this is probably the cheapest home prices will be. And they were saying 5 years. I suppose that could be true. That could likely be true. I wouldn't make that bet though. So he's saying that this is right now, this is as low as prices will be in 5 years. And who cares what happens with rates? Buy the flipping house, right? If rates keep rising, great, you got a low rate. If rates fall, great, refinance into a lower rate, but buy the house, right? And the truth is, market timing, forget about all of it. When's the best time to buy a house? It's when you're ready, right? It's when you're ready. But I know people are rate sensitive, and justifiably so. But remember, if rates rise from here, you got a good rate. If rates fall from here, you refinance into a greater rate. It's not set in stone. So I think that is a message that we should be getting out to people a little bit more. And with that, thank you so much again. I see we have put the link to the next webinar in chat. Thank you, Chris. Thank you, Sean. Thank you, Sarah. Thank you, guys. Thank you, Sarah. Other Sarah, Nurnberger and Hansen. Thank you all. Really just tickled and honored that you guys come and spend time with us and get to geek out on some data. Please visit our website, mplsrealtor.com. Check out the market data section, and you will be surprised and delighted with the number of reports that you guys can see and check out and use with your buyers and sellers. Thank you. I do see my friend Jeff. I see Jeff's face. Oh my God, it's so good to see you. Thanks for coming. He warned me he'd come, and sure enough, a man of his word. Thank you, guys. Thank you so much, and hope to see you all next time.